Welcome to the deep dive. Today, we're cutting through some of the noise to get straight to the strategic heart of corporate finance.
Hmm.
We are tackling the essential principles of balance sheet reporting.
Right.
Our mission is to move past the simple definitions and really understand how every number, every single line item, reflects a critical business decision.
Or an industry constraint. Sometimes it's something you have no choice about.
Exactly. So think of the balance sheet not as just a scorecard, but as a systematic story of what a company owns and how it paid for everything.
That's the perfect way to put it. For you, the listener, the upgrade in your understanding happens when you stop seeing, say, accounts receivable as just money owed,
Right.
and you start seeing it as an insight into a company's sales policy, or maybe how good they are at credit control. You have to connect those accounts with the real-world activities that put them there.
And the one rule that governs this whole story is, of course, the absolute law of accounting.
The equation. Assets must equal liabilities plus owner's equity. Every single transaction has to fit into that framework.
It is the governing structure.
Yep.
It's fundamental. If a company takes on a loan, you see both assets, the cash and liabilities, the loan itself, go up.
Keeping it balanced.
Perfectly balanced.
Right.
Or if they buy a new truck with cash, one asset goes up, another asset, cash, goes down. That mathematical discipline is totally non-negotiable.
And that's what makes it such a powerful tool for analysis.
Hmm.
Okay, so let's unpack the first half of that equation, assets.
Yeah.
What the company has at one specific moment in time.
Mm-hmm.
The main way these are organized is based on time, isn't it? Like, how quickly can we get liquid?
That's the key distinction, yeah. We split them into current assets, so things you expect to use up, sell, or turn into cash within a year,
Okay.
and then long-term assets, which are, built to last longer.
So most people are familiar with the big three current assets. You've got cash, accounts receivable, and inventory.
The classics. But let's look at the strategy behind that. If you see a company with a massive balance in accounts receivable, all that money customers owe them, what does that tell you?
Well, a high AR balance could signal a couple of things.
Mm-hmm.
On one hand, maybe they have really aggressive sales terms.
Mm-hmm.
They're trying to grab market share by giving credit to almost anyone. That's a choice.
A strategic choice.
Definitely.
Hmm.
But on the other hand, it could mean they have a big problem with collections. They're making sales, but the cash just isn't coming in fast enough.
Which is a huge red flag for liquidity.
A huge red flag. So it makes you ask, is this a smart marketing strategy or is it a collections nightmare?
That is a great example of digging in deeper. Now, if we move past that one-year horizon, we get to the heavyweights, the long-term assets, usually dominated by property, plant and equipment, or PPE. This really defines what kind of company it is, doesn't it?
Absolutely. If you look at an airline or a big utility company, their balance sheet is just saturated with PPE, all the planes, the pipelines, the power lines. That asset mix is pretty much dictated by the industry they're in.
But this is where we hit one of the most surprising rules in accounting, something that trips up a lot of new investors. And that's how companies treat intangible assets.
Ah, yes. Things like patents or brand value or software they built themselves.
Exactly.
This is a classic example of that tension between reliability and relevance. The accounting rules, for the most part, only let a company report an intangible asset if it has purchased it from someone else.
So if they bought a patent for $50 million, that goes on the books.
It goes on the balance sheet at $50 million because we have a reliable transaction price. We have a receipt.
What if they spent 10 years and $100 million of their own R&D budget developing some revolutionary AI?
That value might not show up at all.
Wow.
That's right. The immense value created internally, think about Google's search algorithm, is often completely excluded from the balance sheet.
Why is that?
Because how do you assign a reliable dollar value to it?
Oh,
It's highly subjective. So accountants choose reliability over relevance here. They know that if they started letting companies put their own subjective values on things, financial statements would lose all credibility very, very quickly.
so the balance sheet of a big tech company is almost guaranteed to be massively understating the true value of the business.
Without a doubt.
Which means as an analyst, you have to immediately go to the footnotes or just try to estimate that value on your own. It's a huge strategic blind spot you have to fill in yourself.
It really is. It just shows you the balance sheet is only one piece of the puzzle.
Okay, let's switch over to the other side of the equation now. Liabilities. What the company owes.
Mm,
And again, we split this by time. Current liabilities are what you have to pay off in the next year.
right. And the main ones here are accounts payable and accrued liabilities.
Mm.
Accounts payable is basically the free credit a business gets from its suppliers.
So if a business can stretch out its payment terms, say from 30 to 60 days,
It's essentially using its suppliers to help finance its operations.
so managing accounts payable is a quiet but really powerful strategic move for cash flow.
Oh, absolutely. I mean, look at a company like Walmart. They're famously aggressive about extending their payment terms to maximize that operational float.
And when the bills are due further out than a year, we're talking about long-term debt.
Yep. Mortgages, long-term bank loans, bonds. These are the company's major financial commitments,
Yeah.
usually tied to big capital investments.
Which leads us right into the final and often the most complex section, owner's equity or stockholders' equity.
The capital from the owners.
And it's not just one number, it's broken down into several distinct parts.
It is. We start with the stock itself.
Yeah.
And you generally have two classes, common and preferred.
Okay, what's the difference there?
Common stockholders are the true owners. They get the voting rights, they take on the most risk.
But they also get the biggest reward if the company does really well.
Exactly. They have the unlimited upside. Preferred stockholders, on the other hand, they're in a sort of middle ground. They're actually closer to being creditors than owners.
Yeah, so.
They trade away their voting rights and that unlimited upside for more safety. They get a fixed dividend, and they get paid before the common stockholders if the company ever liquidates.
So it's a way for management to raise cash from more conservative investors.
Right, without diluting the voting power of the existing owners.
Now, the money that common stockholders first put in is usually split into two accounts, par value and additional paid-in capital.
Yes, but the real engine of growth on the equity side of the balance sheet is retained earnings.
This one is so important. It's the most direct measure of a company's success over time, isn't it?
It is. It represents all the net income the company has ever earned since it started, minus all the dividends it has ever paid out to shareholders.
So retained earnings is it's the profit that management decided to reinvest in the business instead of handing it out.
Precisely. It's the #1 source of organic growth financing. When you see a high retained earnings balance, you are looking at a company that has been very successful at generating and reinvesting its own profits to fuel its own growth.
And on the flip side, a big established company paying out huge dividends would have lower retained earnings.
Right, reflecting a strategic choice to return that capital to investors instead.
We also often see a subtraction from equity, an item called treasury stock. What's the story there?
Treasury stock is about share buybacks. It means management decided that the best thing to do with the company's cash was to go out and buy its own shares on the open market.
Why would they do that?
It reduces the number of shares out there, which can boost earnings per share. And it also signals to the market that management thinks their own stock is undervalued. Because that cash left the company, it's shown as a negative number in the equity section.
Okay, that makes sense.
Yeah.
And now for the one that looks like alphabet soup to most people, accumulated other comprehensive income, AOCI. This gets pretty technical. Why do some gains and losses just skip the income statement entirely and go straight to equity?
It's all about managing volatility and transparency. AOCI is where you capture specific kinds of unrealized gains and losses. Things like changes in the value of certain investments the company hasn't sold yet.
Or changes in foreign currency exchange rates.
Exactly. So if you're holding a security and its market price shoots up today, that's a real increase in wealth, but you haven't actually cashed it in yet.
So it's not part of your operating performance for the quarter.
That's the key. The accounting rules say that if that gain is really volatile or might be temporary, putting it on the income statement would distort the picture of your core business operations. AOCI captures that change in wealth, so the balance sheet is accurate, but without polluting your core earnings number.
So it's a way to manage the market's perception of your core profitability.
It's an explicit effort to do just that.
Got it. Now, when we actually look at a company's report, it's almost never just a single snapshot in time. Let's talk formatting.
Right. Comparative reporting is essential,
They always show at least 2 years, side by side.
and that immediately tells you the direction of change. Did the company take on a ton of new debt? Did they sell off a major division? The difference between those two columns tells the story of the last year.
And in the U.S., the order of the items listed also tells a story. It's all about liquidity.
Yes, the standard U.S. presentation starts with the most liquid assets, cash, and then it works its way down to the least liquid, like PPE.
Then it does the same for liabilities. Short-term first, then long-term debt, then finally equity.
It prioritizes the immediate financial health of the company.
But internationally, that can be completely flipped on its head, right?
It often is.
Okay.
If you look at a lot of non-U.S. balance sheets, especially under IFRS, they'll present the most permanent items first, long-term assets and liabilities.
So they focus on the capital structure before they get to the daily liquidity.
Exactly. They even sometimes group current assets and current liabilities together and just show the difference, which they call working capital. It's a very different initial picture.
That's a huge difference for anyone analyzing global companies. You read a U.S. firm for most liquid down, but a European firm for most permanent up.
It forces you to adopt a different mindset from the get-go.
Okay, let's move beyond the structure to the human element, the judgment calls. Accountants aren't just bookkeepers. They are constantly making judgments on two big things: recognition and valuation.
Recognition is the decision. Is this item important enough, and can we measure it reliably enough to actually list it as a number in the main financial statements?
And valuation is picking the dollar amount to put next to it.
That's it. And if an item fails that recognition test, maybe it's just too subjective to measure.
Then you disclose it instead.
Exactly. Disclosure is the alternative.
Yeah.
If you can't get to a reliable single number, you describe the situation in words in the footnotes.
Yeah.
You have to be able to define it and measure it to get formal recognition.
And that brings us to the biggest valuation debate in accounting history: historical cost versus market value.
The classic dilemma.
Let's say a company bought a building in downtown Manhattan 50 years ago.
The historical cost is perfectly reliable. You have the receipt. You know exactly what they paid for it.
But that number has zero relevance to today's economic reality. It tells you nothing about its current worth.
Right. And market value is super relevant. It tells you what it's worth today, but it's not always reliable. It can fluctuate, or it might require a really complex, subjective estimate.
So where do we stand today?
Well, modern balance sheets are really a mix of the two. Historical cost is still the bedrock for things like PPE, but we're seeing more and more requirements to use fair market value for certain financial assets and liabilities. It's a constant push and pull to find that right balance.
So let's bring this all back to the big picture. How do we use the balance sheet to analyze a company's strategy?
By analyzing the mixes, we separate what the industry forces on the company from what management actively chooses to do. And this gives us two things to look at: asset mix and financing mix.
Asset mix being the proportion of assets in each category, current versus long-term.
And that asset mix is mostly dictated by the industry. A consulting firm is going to be heavy on current assets like cash. A utility building a nuclear plant has to be dominated by long-term PPE.
That's an industry constraint, not a management choice.
For the most part, yes. But the strategic nuance comes when you compare two companies within the same industry.
Okay.
So differences in asset mix between industries just show they're different businesses. But differences within an industry, between two competitors, that reveals strategy. One company might invest heavily in its own logistics and warehouses,
High PPE,
while its competitor outsources all of that.
low PPE. Those are direct competitive choices.
Exactly. And the second part, the financing mix, tells a completely different story.
This is how they pay for all those assets, the split between debt and equity.
And this is far less constrained by the industry. This is much more about management's appetite for risk and leverage. Do they want to fund the business by borrowing or by selling stock and reinvesting profits?
So an aggressive management team might use a lot of debt, signaling they're confident in their future cash flows.
While a more conservative team might rely on equity to prioritize stability.
And that's really the ultimate insight here.
It is. The balance sheet lays out the industry's requirements on the asset side, and then it reveals management's distinct, chosen strategy for funding those requirements on the other side.
So this deep dive has really shown us that the balance sheet is this systematic story of a business held together by that non-negotiable accounting equation. By connecting the accounts to the actual business activities, you can start to really get it.
And by separating industry constraints from leadership choices, you gain the fluency to understand where a company has been and maybe where it's going.
Okay, so we've established that the asset mix is largely driven by what the business must have to operate in its industry, but the financing mix is driven by management decisions about risk. This brings up an important question for you, the listener, to think about. If you were evaluating a new potential investment, which mix asset or financing would you look at first to get the most direct insight into management's strategic priorities for the future? Which one truly reveals their intended path rather than just the necessities of their market? That's your thought experiment for the week.